So to see huge amounts of delivery of physical silver out of the COMEX is very telling. I think that what it does is it speaks to extreme tightness in the silver market. There is nowhere near as much physical supply available as I think a lot of participants or observers believe. So the first thing is that I think that silver is, uh, if you look at where it was a little over a year ago, still silver's doing quite well. Uh, to the best of my memory, in say February of 2024, it was bottoming around $22 and then made a strong rally within a few months, 6, 7 months to believe it was $35 in October. And then it backed off kind of went sideways in, I would say, the 28 to 30 range for a little while. And then we had a run up again recently. And if you look at silver futures prices, it actually hit the target I was saying earlier this year that in the first half we would reach $35. And we did reach $35, at least temporarily, a few weeks back in silver futures prices. Now, I think that, first of all, even at 30 or $31, that's very strong compared to $22, February of last year. So silver's looking quite good. The miners are, I think, happier because obviously that there have been increases in costs, but they certainly are earning better margins at this point. And I think that we could see considerably higher silver prices in the second half of this year. A few things I think will be driving that. But if we come back again for a moment or two, we saw silver, as I say, run up to $34, $35 recently, and it backed off. It certainly backed off with these big tariff announcements. I think that silver was. It's interesting that silver actually backed off before the announcements, a few weeks before, um, despite gold not backing off. So certainly they've acted differently. Silver has taken, in recent weeks at least, has taken on more of its role, I think, of an industrial metal, which is about 60% of its consumption these days. Um,
How
but I
much?
think
Sorry,
it may have
60.
60, yes. And I think it has, we can talk about that, how that has shifted if you want afterwards, but I think it correcting before gold is almost as though it was sniffing out that we were going to have a higher risk of recession at some point. And it's almost as though it was saying something's coming that will slow down the economy significantly. And because of that, there's a risk that the consumption of silver will fall off, again, it being more of an industrial metal. And to that extent, I think it was sort of foretelling what has happened in the last couple of weeks. Now, I also think that to some extent, a backing off because of concerns of decreased consumption due to a slower economy is warranted. I also think that it's probably overblown by the market. We can talk about details relating to that as well, but I think that overall, after a couple of quarters, perhaps the market will see that the consumption of silver really has stayed very robust for several reasons, and I think that is what points to considerably higher silver prices in the second half of this year. So there are a lot of implications. So just for your viewers to maybe understand a little bit of what has been going on in the silver market, not only in silver, to be fair, gold, copper and other merchandise, other goods and so on. So since Trump was elected back in November, until recently, there had been some talk of, him imposing tariffs. And obviously, the tariff talk got a lot more concrete once he was inaugurated and took over as president in late January. But despite that, the market saw the risk of tariffs being imposed on all kinds of goods that would be imported into the US. So his thinking is that we tariff uh, manufactured goods being imported into the US. that makes them more expensive, and it stimulates consumption at home and production at home in the US. But that risk of tariffs on silver, for example, is like I say, as well as gold and other things, other metals and whatever, got participants in the US concerned that if they had to make deliveries of these metals that they already didn't have control of and that were already in the US, they would have to import them after tariffs were being applied. And of course, they would have to pay that say 25% tariff or so on the value of the amount that they had to deliver to a domestic client. And so we've seen huge flows of silver come out of London, where we have the largest inventories, and flow west to New York. Now, interestingly, a lot of this is, I'm going to say, to some extent anecdotal because there isn't perfect transparency on a lot of this data. But what we do know is that not only was there a lot of silver, like outsized amounts of silver were flowing from London to New York, but when it got to New York, we've had huge deliveries. And you pointed to that. You're absolutely right. March had the second highest delivery from COMEX ever. It's worth pointing out, too, that COMEX was not built or designed for taking physical delivery. It's a futures market, and it was built to trade futures contracts and to use those to hedge prices. So for manufacturers or whomever, deals with large amounts of silver, and we're going to talk specifically about silver. It's the same for all the commodities, but to be able to hedge risks that they may have of silver prices moving up or down. So to see huge amounts of delivery of physical silver out of the COMEX is very telling. I think that what it does is it speaks to extreme tightness in the silver market. There is nowhere near as much physical supply available as I think a lot of participants or observers believe. And this, I think, is proof. On top of it, I mean, it's true that we're looking back because these are March numbers. We just got these tariffs that have, by the way, Trump has backed off on the majority of them for at least 3 months now. We know that as well. There was already
Except
rumors
China.
of that, right? There were already rumors of that, I think, the next day after markets were crushed. But all that to say that this data is looking back. So I think that it's clear that participants were very concerned and took the physical delivery in case they had to themselves deliver to clients to eliminate the risk, right, of not having the silver and that of the silver having to have these tariffs applied to them. So that's very telling. But something also anecdotal about deliveries into New York is that I've heard that not only has there been a lot of silver flowing from London to New York, but also that the we've had higher than normal deliveries, as we've just heard, out from the COMEX to take for participants to take physical delivery, and it would stay in the New York area, and it would stay in private vaults. So the point being really that participants want to have their physical silver. They are not comfortable with, for example, for whatever their reasoning, to hold a futures contract that is basically a promise or an option to take physical delivery.
Exactly.
And there are premiums, what we call exchange for physical premiums. So in other words, a premium between the physical price or the spot price and the futures price. And these exchange for physical premiums have been way higher than normal over the last several months. So again, that speaks to participants really wanting to hold the physical silver and eliminate the risk. I mean, I think that you pointed it out exactly. I think it is that we could get to a point where there truly is. Now, I'll qualify that a little bit. So we could get to a point where the inventories are so low they're critically low, and that is actually has been some of the talk that, or some of the info I've read in the last few weeks, is that the inventories in London, which is the largest, uh, has the largest inventories of silver, have actually come to a level which we would call critically low. The fact that a lot of it has flowed to New York and then that has gone out for delivery, to me speaks to, again, the seriousness and the tightness in the market. So for someone who holds a long silver futures contract and let's say has been counting on, and that's what I think has been going on, as I say, where these inventories have been drawn down the last 4 years, that you've had participants able to go, and again, New York and London were not built for that, but have been able to hold a long a futures contract in silver, whatever that may be, say 2 months, 3 months, and then wait for maturity. And at maturity, go to the exchange and say, "Here's my contract. Uh, I now want to take physical delivery of the silver that I'm entitled to, now that my contract has matured." And you get a major exchange telling that contract holder that we don't have enough silver to meet your we're going to have to pay you out, in cash. And that contract holder says, no, 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 I need the silver, not the cash. I'm
Right.
using this to manufacture solar panels, for example. I absolutely need the silver. That's when I think, someone's going to scream and we're going to hear about it. And that could be the trigger. That's the type of event that I could see being the trigger. I don't think so. I don't think we'll see a major decoupling. I mean, I really think that yes, the ratio is high. It peaked, if I remember right, even maybe if it's sort of on an intraday basis, it peaked at, I think 120 even, or 125. Would have been maybe mid-March of 2020 when we had
25, yeah.
that big panic in COVID. And so, yes, it has moved up lately. It's interesting that, you look at what the circumstances are. Clearly, the market's viewing silver as, attributing considerable weight to the industrial side of it versus gold, which is always the sort of a pure safe haven, and the ultimate safe haven asset. And so because of that, we've seen the preference for gold, especially in the last few weeks, over silver. Um, and so I think that's what we've seen happening. That's why the ratio has gone back up. Gold has gotten, more expensive versus silver. It takes more ounces of silver to buy 1 ounce of gold. But I do think that as the next few months play out, especially if we continue, let's say we can continue to get positive news mostly out of the US, which will be, will trickle down to, globally, that other partners are willing to negotiate seriously and remove the kinds of tariffs they have. Because, it's interesting. Look, I'm not going to pick sides or whatever, but from what I have read, um, Trump put these high tariffs on basically everyone.
Mhm.
And the world's looking on that and saying, well, that's ridiculous. And, so there's really two sides to see here. It's ridiculous. It's too high. It's dramatic. You're killing the global economy. And I'm not arguing with most of that. However, what we, I think, don't appreciate is that a lot of countries do, in fact, have high tariffs
Yes.
on goods coming from the US.
Yes.
And so I have to admit that Trump is correct to varying degrees with different countries, that he is correct that these tariffs are in place. In fact, some of the tariffs are overt and obvious and clear, sort of clearly indicated tariffs, and some of them are not clear. And in other words, they're not made obvious, I guess, to the market. So internally in some of these countries, they do certain things to tax or to tariff some of the goods coming from the US. But the US is still nonetheless aware of that. And so I think that's where he said enough is enough. and I'm basically fighting back. Now, the other side of the coin, however, which interestingly I've heard one person really address so far, and this is his uh, the vice president, JD Vance. He has said that uh, the US has its own advantage, which is frankly, I believe, the reason that these other countries around the world have had these tariffs on US goods. And that is because the US has the de facto world reserve currency, right? So because of that, they have a huge advantage. I mean, they can it's valued highly against most other currencies, and they have the privilege of being able to print it, to practically to no limits. Uh, Most commodities, if not all, are priced in US dollars, so they can essentially go out, print dollars, and go out and buy whatever they want. So that puts all these other exporters to the US at a disadvantage, right? And it puts US imports into their countries, makes them more costly because they have to go out and get US dollars to buy those US goods. And so that is the other side of the coin. So, and I think those are the reasons that these countries have had these overt and not so obvious tariffs on U.S. goods to kind of counterbalance the strength of the U.S. dollar and the ability it gave the U.S. to go out and buy goods from those countries at relatively cheap prices. So that's a long-winded explanation, but hopefully it helps to clarify, maybe a little bit of really what's going on. It's very, very possible. I mean, there are ways that participants like that, um, smaller participants, right? Because I'll give you an example. I was asked just the other day if I thought that silver, would one day be considered a reserve asset. And my answer is no. I just don't see that happening. It's much too small of a market. Um, it's much easier to buy gold and store gold, which takes much less room. It's more readily, it's more readily, I guess, used as money. It's easier to move it around. You move around a smaller quantity for a high value. Um, and there's much less silver available. More than half of it is consumed every year. So the silver market is about, if you look roughly, I'm going to say 1/10 the size of the gold market. I do not see silver really ever becoming a reserve asset. That being said, I think it was last November, Russia said that they were going to start buying silver again for their reserves. Very interesting, right? So they had gold, but they were adding silver, I believe platinum, palladium, and maybe even some other metals. And I mean, to be honest, that I think is more was more of a strategic move. I think because they appreciate to some extent the strategic value of silver, given how it's used in industry, given how it's used in military applications, which unfortunately is something we have, not surprisingly, maybe very, very little data about. But I think that that was probably a lot of the reasoning behind that move. So that's still exceptional. I don't see central banks going back to stockpiling silver. But I do see, to your point, the potential that you'd have these smaller, more nimble participants, like you say, someone like hedge funds, getting into this, buying silver in significant quantities and then realizing that it's very undervalued and having a lot of patience and being able to wait for this to play out. There's different ways they could do it. They could do it in a leveraged way as well. But that's something that would happen. The thing is that, these nimble players are going to do that, I believe, in a private way, at least as they accumulate, right? So they can continue to buy the silver, not make any kind of announcements, but perhaps when they're done buying, then they would, be more public about it. But yes, a player like that. The thing is that, for them to, as I say, have access to sufficient silver, um, it is not, it's not, I'm not going to say it's difficult because they can buy silver ETFs where they could take delivery. They could buy, there are several, some are better than others. They could do the regular way I was saying before. They could buy the long futures contracts and take delivery. They could just go out and buy physical silver. There are all kinds of, participants where they can, or even large bullion dealers where they could flow large orders through and do it on a gradual basis and stay very quiet about it. Um, but it's almost hard to see how that would be enough of a trigger, only because they would do it in a gradual sense, right? If they wanted to accumulate a significant position, they would do it quietly. And then the impact, I think, would be only when they came out and made it public.